Hello, and welcome to part two of BFSG's 3-week financial literacy series, Money Mastery. This today being about building a strong foundation, discussing saving and investing. A few housekeeping items before we begin today. There's a Q&A box in the Zoom menu on your screen for all of you logged in on the computer. This is distinct from the chat box. Please type all questions into the Q&A box, and we will either type a response or address all questions during a live Q&A for all participants at the end of today's content. Should your questions be more personal in nature, we will provide contact information at the very end of today's session, such that you can reach out directly to ask those questions rather than asking them on a live and recorded webcast. We will not be unmuting lines today for compliance purposes, so please type all questions into the Q&A box again. Lastly, this series is a result of a number of surveys conducted by our participants. So please fill out our 1 to 2 minute survey at the very end. We will produce links inside the chat box for everybody's reference. With that, let me pass it over to our panelists for introductions. Keith.
Great, Chad. Thanks a lot. Well, first of all, I would like to thank everyone for attending today's webcast on connecting the dots to your financial future. My name is Keith Johnson, and I am a senior education specialist and financial planner with Benefit Financial Services Group. I'm joined by Mike Albee. He is a senior portfolio manager and also co-presenter of today's webinar. Mike, why don't you take a moment to introduce yourself?
Thanks, Keith. As Keith mentioned, I'm a senior portfolio manager with Benefit Financial Services Group, and I've been with the firm for 13 years now, and I'm also a certified financial planner, as is Keith.
Thanks, Mike. So also joining us today, part of our panel, we do have some folks from our financial planning team. They may chime in during the question and answer part of this session towards the end of the workshop. But at this point, I will turn it back over to Chad, and he's going to kick off today's presentation with our first interactive poll.
Great, thank you, Keith. So again, for everybody on here, this is an interactive poll. It should pop up on your screen in just a moment when I launch it. The first question, I think this is one of 4 we have for you today, just to kind of keep everybody engaged. So the first question is, really a fun poll, is what percentage of Americans could access $1,000 in cash from their savings account if it was needed tomorrow without using a credit card? So I'm gonna launch polling. I'll leave it up for about 20 seconds as we gather responses. That's great. So with most people having responded, let me close polling and I will share results with the group. We do have a mixed reviews here. We got about 20% between 20%, 30% say 30%, 20% say 50%, and a few people say 10% or almost everyone, right? So let me pass it back over to Keith to actually talk about the real results.
So that is quite a mixed bag there. So let's talk a little bit about saving and investing. So there are different ways you can save and invest. I would imagine most of us on this call, you're familiar with savings accounts or CDs. These types of accounts, they're great for building your emergency fund. So experts agree you should have between 3 to 6 months living expenses set aside in a safe interest-bearing account. So in the event something unexpected happens, you can get to that cash right away, regardless of what it's paying in the form of interest. So in addition to an emergency fund, your foundation there are other accounts that can help you save towards retirement. There are brokerage accounts. Brokerage accounts allow you to save on an after-tax basis, meaning you've already paid taxes on the money, so there's no special tax treatment. With that being said, there are no withdrawal penalties either. So this differs from retirement accounts like 401ks, 403bs, 457s, or IRAs. When you invest in these types of accounts, there can be favorable tax treatment, especially when you're putting the money in on a pre-tax basis. So you get the immediate benefit of reducing your taxable wage base. And now at this point, in this day and age, many employers have the option of an after-tax account or a Roth account.
Hey, Keith, a couple of things. I get a question all the time from clients is, should I open up an IRA or a Roth or utilize the Roth 401k in my retirement plan? Any thoughts on that?
Yeah, absolutely. So when we talk about planning for retirement, it's important to create balance between your pre-tax income sources and your post-tax income sources like Roth. So again, there's no immediate tax benefit when you contribute to a Roth. However, the money still grows on a tax-deferred basis, and all contributions can be withdrawn tax-free, assuming you have that account open for 5 years and age 59 and a half. And I think I could probably argue right now the versatility of the Roth is more important than ever before. So relatively speaking, we're at historical low tax rate environment right now, at least through 2025. After that, things can change. So we could actually return to historically high tax rates. So when you invest in a Roth account, you eliminate any uncertainty of higher taxes and what might happen in the future. So even if you think you'll be in a lower tax bracket throughout retirement, you may want to consider a Roth as part of your overall retirement plan.
Okay, great. And I think we're all dying to know when we did that poll in the beginning, what's the most people, what kind of savings do they have? I think it's 30%, right?
Yeah, about 30% would be in a position to go ahead and satisfy that $1,000 unforeseen expense.
Yeah, so definitely having those savings, that 3 to 6 months is key. That first bucket, which I think Paul and Arash talked about on the last webinar.
Yes, thank you for that, Mike. Okay, so as you begin to invest, it's important to build a diversified portfolio or make sure you don't put all of your eggs in one basket, so to speak. You'll typically want to own stocks, bonds, and cash inside of your retirement accounts. So when you purchase a stock, you essentially own a fraction of the company versus purchasing a bond where you're basically loaning money to a company or government entity. We talked a little bit about cash and the importance of that emergency fund. I think one thing to note with this slide is that every single one of these investments, they carry risk. So while stocks have outperformed bonds or cash over the long term, returns are not guaranteed and you can lose money. So there are also risks when you invest in bonds, something called interest rate risk, or the issuer could actually default on the payments. And even with cash, and believe it or not, there's risk there as well. It's called inflation risk. So if you have all your savings in cash type vehicles, you could run the risk of significantly reducing your purchasing power over the long term.
Yeah, and we definitely see that today with cash paying close to nothing and inflation running around 1.5, and the Federal Reserve has talked about bringing that up to 2.5 or so. So there's definitely a risk there with cash. So we're going to dive a little deeper into those investing risks. Risk taking, as Keith mentioned, is inevitable. It's part of investing. There's no free lunch, and your original investment could always be worth less than where it started. Nevertheless, the market's constantly pricing securities to reflect a positive expected return going forward. Otherwise, people wouldn't invest their capital if they were expecting to lose money. The performance of the stock market can be widely different from day to day, week to week, and year to year. And you do be well to consider volatility to be normal. Bonds tend to be less risky than stocks. And a key reason being is a bond is a contract between the issuing company and you as the bondholder. So the company must pay interest on that bond on specific dates and must return your principal at the maturity date. Stocks don't provide that same level of commitment to shareholders, as a company can suspend dividend payments and investors really have limited recourse other than selling the stock. In addition, bondholders are more senior in the company's capital structure than stockholders. And so in the event of bankruptcy, which does happen, bonds usually recover a portion of their principal, whereas stockholders do not. So higher risk asset classes, such as stocks, come with more volatility, but over the long term have historically provided higher returns than cash and bonds. That's that risk reward trade-off. So one of the most important distinctions between stocks and bonds is that they tend to have an inverse relationship in terms of price. When stock prices rise, bond prices fall, and vice versa, typically. That's how bonds act as like an anchor to your portfolios to help minimize your downside risk. Combining asset classes that behave differently in different combinations helps create a risk profile that matches your personal risk tolerance. And we're going to talk more about that later. So now that we've gone through some of those risks, let's focus on how do investments make money. Growing up, whenever I asked for money from my parents, they would say, money doesn't grow on trees, or go water the money tree. I never enjoyed that response. I still didn't like it. I didn't like it as a kid. My kids don't like hearing it now that I say it to them. But however, years later, I now appreciate the concept of having a money tree. So my money tree is growing in the stock and bond market from interest, which is generated from bonds and cash, the dividends from stocks, and then market appreciation over time. So when your investment appreciates, you can sell that investment at a higher price than you paid for them to generate a profit or a capital gain. So capital gains then can be used as income, or you can reinvest that. Just note that when you have a stock paying capital gains, if it's in a taxable account like a community property or a joint account or a trust account, you do get taxed on those capital gains depending on your holding period. So if it's a long term, if you held it for more than a year, it gets a preferential tax treatment versus short-term capital gains if you hold it for less than a year. So who needs a side hustle when you've got a money tree? More importantly, I think Kendrick Lamar said it best, money trees is the perfect place for shade. My money tree provides shade, AKA protection, when emergencies pop up or for helping me fulfill my goals and dreams. A pretty smart guy here on the screen. And he called the greatest invention in human history is compounding. So let's find out what compounding is. And that got Einstein so excited. So compounding is when accumulated interest that you earn each year is just added to your principal. So that balance doesn't merely grow, it grows at an increasing rate. So what this chart is showing is the outcome of saving $5,000 per year for 40 years, and then having that grow at a 6% rate each year. Over the course of those 40 years, you can see this person in this example contributed $200,000, but earned $620,000 on top of that. That's that compounding effect. Money properly cared for over time will grow and multiply. So at this point, we're going to pause for a second poll.
Great, thanks, Mike. So the next question we have is kind of differences in savings. Kind of thinking through the difference in your account balance if you started saving at maybe age 25 versus 35 versus 45. So the question is, how much would a 25-year-old need to save per month to have $1 million 40 years later at age 65, assuming that their portfolio was invested in diversified mix, stocks and bonds, and earned about 6% per year? I'm going to launch polling right now. Again, I will leave it up for about 20 seconds. Great, and with most responses looking to be in, let me close polling and I will share results here. And again, it looks like we have a very smart group with more than 40% saying about $500. That is the correct answer, since Keith didn't give the first correct answer right off the bat. About over 20% said 1,000, about 10% said 1,500, and about 20% say 2,000. So let me stop sharing. I'll give it back to our panelists to kind of talk through. I think the most important thing on the next page is the difference in savings. If you started at 25 versus 35 versus 45, how much money would you need to save to get to that rate? Let me pass it back.
Okay, so first and foremost, we've determined compounding works. And the example in the poll we just talked about, the 35-year-old has to save twice as much as a 25-year-old in order to be a millionaire at age 65. So $1,000 basically versus 500. So I think the lesson here is to start a program of steady savings, increase those monthly contributions over time as your salary increases. That has a surprisingly powerful impact on your long-term results. So again, savings, this is the number one factor in reaching your investment goals, and investing can put your savings to work. So this graph, as we look at this here, reflects 3 different investors, one starting at 25 and making yearly contributions of $1,200 for 40 years. Another starting at age 35, 10 years later, and making yearly contributions of $1,600. And then a 45-year-old making annual contributions of $2,400 for 20 years. They each earn 6%. The 25-year-old ends up with $63,000 more than the 30-year-olds and $103,000 more than the 45-year-olds.
Yeah, Keith, I know plenty of people who had a blast spending lavishly early on in life and then really had to hunker down and save extra to try to reach their retirement goals. Oftentimes, what we see is those spending habits that you create early in life follow you. So it's not easy to be a big spender early on in life and just say, now I'm going to go on a budget and save extra. That's usually when you want to enjoy retirement. So it's just something we see all the time, and saving is really the number one factor, as you mentioned.
Absolutely. Okay, so we talked a little bit about the risks of investing in stocks. The markets are going to go up, they're going to go down, sometimes very abruptly, and we're seeing that very much this year. What's important to realize is that this is normal. Plus what the markets do, that's totally out of your control. And when we talk about investing, it's important to focus on what you can control, like a long-term perspective or buying when the market's on sale. Not what we can't, like interest rates or any other economic factors. And this is a really difficult proposition because much of our decision-making surrounding investing, it's absolutely emotionally driven. So at this point, we're going to actually pause for our third poll. I'm going to put it back over to Chad. Chad, take it away.
Great, thanks, Keith. So our next poll is, the slide is relevant to this one. So definitely pay attention to what's going on the slide. They're really the emotional market cycles. And based on your opinion, just for fun, where the market is today, where are you feeling as part of this cycle? Optimistic, enthusiastic, euphoric, or uneasy, or maybe somewhere in between? Let me launch polling, and I'll keep it up again for about 20 seconds. So with most people seeming to have voted, let me end polling again. And again, I will share results. It sounds like the bulk of people out there on the uneasy side of the market today, with another about 20% saying somewhere in between, about 25% saying optimistic, and then a good mix between enthusiastic and euphoric still. So let me stop sharing results. I'll give it back to Keith and Mike.
And again, there's no right or wrong answer when it comes to this. It's all about time in the market, not trying to time the market. That will help you get to your long-term financial goals. So we don't want to panic sell based on the news report of the day. Build a portfolio that fits your risk tolerance and stay the course.
Yeah, so I mean, it's not surprising to see people coming back as uneasy. I think optimistic was another large one. And what we see in news and financial commentary can definitely influence people's views of investing and cause them to flee the stock market, typically at the wrong time. Some of you may felt that way earlier back in February and March with the coronavirus, even now with the elections. But look at the last decade here. And there are other reasons that you may have gotten scared to get and tried to get out of the market. Trade war, Brexit, downgrade of US debt. Just remember, the media needs viewers and clicks to make money, and selling fear elicits more of an emotional response. So, and people may also follow advice of friends, influencers, or family, especially if that insight promises a fast and easy return. But growing wealth has no shortcuts. Success requires a solid investment approach, a long-term perspective, and discipline to stay the course. Holding stocks for the long run increases the odds of making money in the stock market. A recent article in Barron's quoted that you have a 46% chance of losing money if you hold the S&P 500 for just one day. So almost a 50-50 chance of losing money in any given day in the stock market, but just a 6% chance of losing money if you hold on for 10 years. And then missing out even on those few of the market's best days each year can have a significant impact on cumulative returns. So you can turn great returns into paltry ones. So it's, again, as Keith mentioned, time in the market, not trying to time the market.
Absolutely.
And so with the focus on taking that long-term perspective, and part of that taking that long-term perspective is dollar cost averaging. This is a tool in the tool belt that we use. And what it is investing the same amount at regular intervals. In this example, it's every 6 months, but it could be monthly, every other week, whatever. But depending on the level of the stock market, you may end up buying more shares for less or more but it just lowers your market risk by averaging the prices out. So for those of you contributing to a retirement plan, you're already doing this. Each pay period, your contribution comes out of your check and it's invested in the market. You're dollar cost averaging by doing that. All right, so don't get freaked out on this slide. I'm not going to test you on your elements in a periodic table. Chemistry was not one of my strengths. What the slide is showing is the various asset classes you can invest in and their performance over time. So one thing you'll notice is the frequent change in leadership from year to year of the various asset classes. For example, let's just look at emerging market equities. The far left of the slide, at the very top in the purple box, EM equity. So these are stocks located in like Latin America, Asia, like China, and so on. Emerging market equities back in 2005 was the best performing asset class. And it was doing pretty well until the financial crisis hit in 2008. And then it came down 53% all the way to the bottom. And then in 2009, rebounded with a 79% return. It's just all over the board. And you can really choose any asset class and see a similar outcome. So we believe investors must diversify both to mitigate losses and also to participate in gains. You want exposure to that emerging market asset class. But you just don't want to put all your eggs in one basket. I like using a golf analogy in explaining diversification. I'm always trying to smash the ball off the tee, and most of the time hitting a slice or a hook. But every once in a while, I do bomb it down the fairway. Chad might agree otherwise. He's a pretty good golfer. But my wife, who plays boring and doesn't hit the ball very far, she won't like me saying this, but she always ends up beating me when we've played a full round. She balances her risk and potential reward. Diversification is the same. It's boring, but over the long run, you win with a lot less volatility. Although broad market diversification cannot insure against a loss, it does help guard against unnecessarily large losses. And according to well-known studies, more than 90% of the variability of a portfolio's performance over time is due to asset allocation. This is the key, the selection of these asset classes and the weights. It's not the next hot stock of the day, the IPO of Snow or whatever that came out a couple of days ago. It's not trying to time the market. This is why I'm in finance. I'm not a golfer. At this point, we're going to send it back to Chad for a final poll, and it's going to be asking what his handicap is.
Yep. Thanks, Mike. Nice. I love that example. I think everybody knows somebody that put a bunch of money in a penny stock or bought Bitcoin at the right time or Tesla at the right time and made a ton of money on it. But for every one of those investors, there's 5 to 10 investors that put all their money in one stock and ended up losing everything they own. So definitely diversification is the best approach, at least for a retirement account and long-term savings.
Yeah.
So going back to that, I think so. Mike had an example back in 2009 on the slide. You have EM equity, that made 80%, but just lost over 50% the year before that in 2008 during the financial crisis. So with that in mind, this is just an easy math question for everybody, but we're always surprised how many people get this question wrong. So if your portfolio were to fall from $10,000 to $5,000, that's the 50% loss. What percentage would you need to earn to get back to $10,000? Let me launch polling. I'll leave it up for about 20 seconds. Great, and so with most of the responses looking like they're in, let me close polling right now. And again, I'll share results. So again, it looks like we have definitely a really smart group out there with almost 50% saying you need 100% return to make up that 50% loss. And that's correct, right? If you lost 50% and we're down to 5,000, you would need to make 5,000 just to get back to that original $10,000. Right, so I think we had about 20% that said 25% and 12% at 10% and 50%, and about 10% said 150%. The correct answer again is 100% gain.
Yeah, definitely a trick question there, but yeah, you must double your money to break even. So just to recap what I went through and what Keith is going through, the 4 keys to accumulating wealth is starting early. The sooner you can start early and investing, the more benefit can be gained from compounding. And then keep that long-term perspective. And then begin with the largest sum possible. Again, it helps with the compounding. Save on a regular basis. We discussed dollar cost averaging as a way to do this. and then reach for the highest rate of return that's acceptable for you based on your time horizon and risk tolerance. Seth Klarman, a well-known investor, has stated that the best investors do not target return. They first focus on risk and only then decide whether projected returns justify taking that particular risk. So at our firm, we always do a risk tolerance questionnaire to figure out what's your capacity to take risks, what's your willingness. We survey what's your time horizon. Then we come back into that targeted return and the proper mix of stocks and bonds and other asset classes.
Absolutely. Okay, so some tips here to start creating healthy savings plans and habits. Pay yourself first. Put your savings on autopilot by contributing to your employer-sponsored retirement plan.
Yeah, and if you're fortunate enough to get a raise, increase that contribution to the plan accordingly.
Absolutely. You don't want to take on more debt than you can afford. Yes, it might feel good to go buy the 65-inch TV, but is that something you should be taking on debt for?
Exactly. When you consider debt, think about good debt and bad debt. A mortgage would be considered good debt, especially today. You can finance it at around 3% or so for a 30-year mortgage. And over time, at least historically, that asset has appreciated. Your house has appreciated, or rental properties or whatever. Unlike a car, which is usually considered bad debt, because that car, the second you drive it off a lot, it starts depreciating. So getting a 7-year car loan on a depreciating asset, that's what most people consider bad debt.
Yep, absolutely. And pay down the credit cards. There's some strategy around here, but do that as soon as you can. And you want to look to pay more than the credit card minimum that you see on the statement.
Yeah, if you didn't catch the first webinar, Paul and Arash had a great example of strategies to pay down those credit card minimums. There's a reason credit card companies are now required to warn you of the costs associated with only making a minimum payment.
Yep, absolutely. It's important to understand your employer's retirement plan. Consider contributing at least enough to get that full company match if that's something that's being offered.
And then we talked about the Roth 401k. See if that's an option inside your plan. And I know Chad's going to also post in the chat box, there's a Roth webinar and the difference between a Roth and a Roth 401k that we recorded roughly a year ago, and he'll put that link in the chat box.
And a side note, that's not just 401k. It can be Roth in a 403b plan, 457 plan. We have people from all of these different plans and working with governments and whatnot at universities. All of those plan types do have a Roth bucket. It's just a matter of whether your employer has turned it on or not. But if your employer's turned it on, it's definitely something that's beneficial.
Yeah, thanks for the clarification, Chad.
Great point. Also important, create a budget, track expenses. If you don't have any resources for that, we do have templates that you can use. We can forward those along if that's something you're interested in.
Yeah, and even check out your bank's website. Most have some type of budgeting tool available today.
And wrapping it up here, set financial goals, have a plan. But it's important when you set those goals, make sure the first goal is attainable. It's a small goal, and basically build off that.
Yeah, and then write them down. Studies suggest that you become 42% more likely to achieve a goal by writing it down.
Yep, and I think, Mike, you alluded to this. A lot of these tips were discussed in the first webinar on financial literacy for budgeting and saving. If you didn't get a chance to catch that webinar, again, Chad's going to be posting that. So if you're looking for some additional resources, check out our website. You'll find financial planning calculators, educational videos, as well as our blog. So to wrap everything up, we've covered a lot of material. You may have additional questions. First and foremost, it's always recommended you reach out to your financial advisor for any answers on financial topics. If you don't work with an advisor, but you would like to talk with one, we can help. You're invited to schedule a call or a video consultation with one of our BFSG financial planners. Here you can ask your most pressing investment questions, retirement questions. We can also help assist in you taking that first step forward to build a solid financial future. Or even if you want to take a look at how you're allocated in your investments, we can actually provide you with a complimentary investment review. So again, I would like to thank everyone on this call for listening. At this point, I will turn it back over to Chad for Q&A.
Great, thanks, Keith. And so really quickly, thanks for a great presentation, you two. In the chat box for all of you that are attending, I did just post a series of links for everybody. I think the first one is a link to the Roth to where you can find that Roth presentation that Mike and I did early last year. It's just on bfsg.com/BFSG University. I think it's the first one actually on that list. It's about 12 minutes, so relatively short, just to give a discussion about the differences between pre-tax saving and Roth savings and differences over long term and implications in retirement. The next thing again, there's a link to today's slide deck for anybody that would like to download the slides just for future reference. That will also be in a post webinar email that comes out from us in Zoom. And then a survey link for all of you that are willing to complete. It is only 1 to 2 minutes, just to let us know what you thought of today's content and any suggestions you might have for future topics that we also will produce over time. Next piece, the third one is the registration link. I know there is a link on the screen right now, but is the direct link to register for part 3 of this series, the last, which is focused specifically on education planning. So those of you looking towards college, or that might have young children that will be looking to college relatively soon. And then the last one I posted is also a link to the replay from last week's session, especially for any of you that missed last week's session. We talked about paying down credit cards. Last week's session focused pretty much on credit cards and building good credit over time, and talks through a couple strategies to pay down credit cards if you do have that debt outstanding. So with that in mind, as I mentioned, there is a Q&A box on the screen. So for any of you that have not already asked questions, we do have a number of questions in the queue right now. Please type in your question in the Q&A box and we will address them in the order that they are received. So with that, let me kick off with the first question. How do I invest if I have no savings? Noting I have no debt either.
It's great that you have no debt. First off, that's great. I mean, for the savings, as Keith went through, first is create that emergency reserve. And that's probably getting on a budget so you can have some discretionary spending after all of your expenses, figure out what that is, and then you can start saving to that emergency reserve first. And then once you check that off the list, again, put that list, write it down, something attainable, then move on to the next one. And then your retirement plan is a great place to start as well. Keith, do you have anything you want to add there?
Yeah, and again, those accounts, as Mike had mentioned, savings accounts, CDs, no, the interest rates aren't there right now, but that's not the point. It's the liquidity. That's, again, your foundation right there.
Yep, great. So our next question is, can we review the options and avenues to save with compounding interest? Interesting question, because typically a savings account might be one of those, but with interest rates at about 0.01 for my Wells Fargo and Chase savings accounts, maybe not the best place in the bank account anymore.
Yeah, it's not the good old days of the early 80s, but that was when inflation was high too. You have limited options to compound interest when interest is so low in cash accounts. And as we mentioned, the emergency reserve shouldn't be looked at as an investment account. That's if what hits the fans and you need money, you're going to go to that, and that way you don't have to pull from your retirement account and take a loan or some other account or take on debt. So you start compounding interest with stocks and bonds. Bonds produce more income than cash right now. There's a little more risk, obviously, than cash, as Keith went through the different risks. But even bonds today, producing income for a government bond, a 10-year treasury bond is around 0.7 today. And so then income goes up to about 5%, depending on how risky you go. And then equities or stocks produce income from dividends. The typical dividend yield on a stock is about 2%. And then you also start getting that appreciation of those bonds and stocks. And that's where the compounding comes in, is really income and appreciation from dividends and interest and appreciation.
Yep, thanks, Mike. So next question we have is, would you suggest paying down a jumbo mortgage to refi from an ARM into a 30-year fixed rate conforming loan, especially even more so, regardless of your recommendation on that, if you were to do so, would it make sense using a 401k withdrawal to get the conforming loan to about $765K?
Keith, do you want to take a stab at this one? I'll
Well,
chime in.
on the 401 side, I would need to know, clarifying withdraw, taking a loan or withdraw. Those are two separate things. Some 401k plans allow for in-service withdrawals. When you take a loan, you take that money out on a pre-tax basis, basically, and pay it back with after-tax dollars. So there are a ton of tax considerations there when we talk about, yes, interest rates are low, but taking that money, you don't want to sacrifice your retirement, I guess, for a short-term need, if that makes sense.
Yeah, I would agree. Going from just the refinancing part of it, from a jumbo adjustable rate mortgage into a 30-year fixed, we're at historical lows in interest rates. The Federal Reserve has mentioned just the other day that they're pretty much on hold until 2023. So we're probably going to see low interest rates for the next few years, but I believe personally that now's the time to lock in those rates at a fixed rate. Why have something adjustable? And we'd have to know the terms of the loan and everything. But if you want to reach out to us, we can evaluate it further.
Absolutely.
Great, thanks, guys. So next question is, do 401k contributions, in your opinion, count as savings?
For sure, yeah. Those are savings for a goal, which is typically, I mean, your retirement goal. And so what the rule of thumb is, typically you want to, depending, I mean, you started early, saving early, is you want to be saving 10% a year. And that definitely is one of the buckets is your retirement contributions to a 401k, 403b, or whatever.
Yes, I think, the rule of thumb, I think, that Paul and Arash talked about in part 1 of this series was the 10-10-80 rule. The idea that you should live on about 80% of your income. 10% should go towards funding your short-term savings initially. And then once you've kind of hit your short-term 3 to 6 months emergency savings account, then start putting that 10% into the midterm bucket, thinking 3 to 5 years, plus or minus. But that other 10% should always be going to your retirement account. So that could be either your employer-sponsored retirement plan or an IRA, maybe a combination of those two. I think the rule of thumb in retirement accounts is that you should have saved about 15% between both your contribution and your employer's contribution over the course of your entire career. So if there's 1 year that you're only saving 5%, and then at some point you're going to be needing to save about 20% to accomplish that goal. So definitely starting early, saving at least 10% in your retirement account, or between your retirement account with your employer or your IRA, definitely a good place. Savings account at the bank count as savings, a brokerage account that you have after tax outside of a retirement vehicle, savings. Rental properties could be savings. I think the one big asset that we typically say should not be counted for towards your savings and your retirement goals is your primary residence, right? So the house that you're living in is not considered an asset for your retirement account, because at some point you're still going to live in there. So when you retire, you might downsize and take out some of that cash, and maybe it helps fund your retirement account, which you'll probably always need somewhere to live. So your primary residence is probably the one big asset that we typically do not consider part of your retirement assets.
Yeah, absolutely. And just something, you're exactly right. And then with that being said, it shouldn't be looked at if you have a HELOC or a second, that shouldn't be your emergency fund, so to speak. So that's something we want to build up. So Chad, 100%, I agree 100%.
Yeah, we saw during 2008, those home equity lines of credit or HELOCs, a lot of them were closed out if they weren't tapped already by the banks, because they were trying to preserve capital too. So that, don't use that. I mean, it's a nice option to have, but I wouldn't purely rely on that as your emergency reserve.
So our next question is coming over from the chat box this time, is what would you suggest for short-term savings, such as savings for a down payment on a house?
Yeah, typically you want to, I mean, depending on when you want to buy that house, you want a good, I mean, something solid in cash. You can lock it up maybe in a CD or certificate of deposit if you know you're not going to need it for a year for that down payment. There's plenty of banks out there offering CDs for 1 year. We recommend keeping it short term right now. I can send you afterwards if you want to reach out directly to us, some banks where we feel there's competitive rates that are FDIC insured. But yeah, you're not going to earn a ton on that short-term investment. You're just trying to get a little, at least keep up with inflation.
Yeah, I think part of that goes into how much you already have saved and how much more do you need to save, right? If your time horizon for this is 1 year, then a 1 year CD probably makes sense, because the last thing you need is to have $50,000 in the stock market, and you're ready to buy a house, and all of a sudden the stock market's down 20%, and all of a sudden you don't have enough money to make your down payment. So I
Yeah.
think if 1 year out, having a CD might make sense. But if you're looking, 5 to 6 years out, then it might make sense to build a balanced portfolio of stocks and bonds, and invest it, because you have at least the potential to accumulate some additional wealth, part of that compound interest in the stock market and in the bond market.
Yeah, as I mentioned previously, I mean, risk tolerance and then time horizon are key. So knowing your time horizon, then you can maybe take a little more risk if it's a longer time horizon. If it's shorter, then you can't be taking on that risk.
And so our next question, again, coming from the chat box is, again, looking at mortgages and loans from the 401k, what are our thoughts on, is it a good idea to take a loan from the 401k account to put a down payment, for your mortgage? And if so, what's the percentage that you can get from your 401k savings?
Keith, you can take this one.
I can answer the
Chad,
latter
yeah.
part.
Yeah, Chad. Okay.
The latter part of that is you can get, for most retirement accounts, be it 401k, 403b, 47, et cetera, you could take up to the lesser of $50,000 or 50% of your account balance. So if you have, say $50,000 in your 401k, then you can only take $25,000 out as a loan. But if you have $100,000 or more, you can take up to $50,000 for that loan. There are exceptions. Some of you may have heard because of the CARES Act. If it's a COVID-19 related reason, you could take, for some plans up to $100,000 or 100% of your account balance. That being said, purchasing your primary residence and putting a down payment, it does not count as a COVID-19 related reason. So for this type of loan, again, it would be the lesser of $50,000 or 50% of your account balance. The benefit of that, if you were to do that, I mean, building equity in a home is always a good thing. So I'll let Keith get to his answer in just a moment as well. Having a house versus paying rent, I think it's a personal preference, right? Nobody can tell you what the best thing is for yourself. At the end of the day, even myself, I took a hardship withdrawal and paid taxes and a penalty so that I could buy my house when I first did it, because I was tired of spending, like $2,500 a month in rent living in Southern California. So I think it does depend on personal preference. But Keith.
I think with this one, there's a huge opportunity cost here. Any money you take out of the 401k is no longer invested. So if the markets continue, I mean, we've been in a bull run for 10 plus years here. There's a tremendous opportunity. And what, looking long term, will that cost you for retirement when you stop and think about that? And then coupling the fact that interest rates are so low right now, in my opinion, maybe that's more of a last ditch effort, if that makes sense.
Yeah, I would agree. The opportunity cost and interest on the or paying yourself back. I mean, you stop contributing to your account because you're paying off the loan. So there's things to consider. And yeah, I would agree with you, Keith.
Yeah, let me add to that too. Something I think a lot of people don't think about when they do this, right? So when you take out a loan from your 401k to purchase a primary residence, unlike a normal loan from a retirement account that has to be paid back over 5 years, your primary residence loan can be paid back up to 15 years. But when you think about how much money you're taking out a loan, even over 15 years, if you take out $50,000 to put a down payment, just definitely do the calculation. The loan site will help you with that. For how much is that going to cost you in each paycheck, right? Because if over that 15 years, it's going to cost you so much from your paycheck that it's putting a damper into your ability to even pay your mortgage, then you might be only repaying that $50,000 to the 401k or 403b, 47, and never actually contributing in excess of that, right? So a lot of people that take a loan, they still continue to make their 10% contribution plus a loan repayment. If the loan's so big that it impacts your paycheck that you can't actually make a contribution other than repaying your loan, then all you did is taking all that money out of the market. You're not actually saving anymore for retirement, and over 15 years, you're going to get back to where you used to be. So definitely think about the potential impact to your paycheck for taking this loan out and how many years you're going to have it out.
And Chad, you want to also touch on if they leave their employer when that loan becomes due?
Absolutely. That's one of the best comments. So I think if you took a $50,000 loan, you think you're going to stay with your employer for a long time, but something happens. Either you find a new job, maybe your company downsizes, or for whatever reason, you are no longer employed by the same company. And say you still have $40,000 left outstanding on that loan. All $40,000 becomes payable today, the day you leave your employer. So if you do not have the cash to pay back that $40,000 loan or whatever the loan balance is outstanding, then it's going to be considered a distributable event. And what that means is that $40,000 is now going to become part of your taxable income that year, which means it might increase you to a new tax bracket. In addition to that, you're also going to pay all of your taxes on that loan, right? So now it depends on what your tax bracket is, but taxes are due to the government that year. And then on top of that, you have a 10% federal penalty for taking an early distribution from the retirement plan if you are not age 59 and a half. And for all of you on the call that happen to live in California, California is the one state in our beautiful union that tax on an extra 2.5% penalty tax as well. No other state has that. So you're really looking at whatever your normal taxable income would be, tacking on an extra $40,000 that you wouldn't have already paid taxes on, right? So any refund might be gone. You might end up owing taxes, plus a 12.5% penalty if you live in California and a 10% penalty if you live outside of California. So definitely some big consideration to think about if there's any chance that you leave your current employer before that retirement plan loan is paid off. Next question is, how do you recommend managing the mix of stocks, bonds, and cash? Is a target date retirement mutual fund recommended?
Inside of a 457, 403B, 401k, I really like the target date funds. And if you're not familiar with how those work, basically you select your date for retirement, and inside of the portfolio, you have a diversified portfolio number one. So that accomplishes that. It's more aggressive early on, so you have more invested in the stock market, and then gets more conservative as you get closer to your projected retirement date. And it's also rebalanced and monitored, so to speak. The one shortcoming that the target date funds have is they don't take into consideration your own personal risk tolerance for investing. But if you're someone who's more hands-off, you don't want to deal with this, you want to make sure you're good in your retirement account through your employer, I think it's a great option.
Yeah, it's kind of a set it and forget it. And it touches on a lot of the things we covered: diversification, investing for the long term, rebalancing, and then if you're doing dollar cost averaging into your plan. But just note, this should be your only investment in the plan. You shouldn't have a 2045 target date fund and a bunch of other mutual funds of holding other stocks and bonds, because then you're kind of messing up the allocation based on when you're looking to retire.
Yeah, let me tack onto that. That exact comment is the idea behind a target date fund is, the provider, be it Vanguard, T. Rowe Price, Fidelity, whoever that might be, they are managing that portfolio as if it is all of your retirement savings. So it's not taking into account your IRA, any brokerage accounts, any savings accounts. It's not taking into account any other assets. It assumes this is your only retirement asset. So the mix of stocks and bonds that they have for each age group is kind of dependent on that. So definitely make sure you have that allocation set. You're picking the year and the target date fund associated with when you are anticipating to turn age 65. They're not based on, if you're planning to retire at age 55, picking the target date fund affiliated with retiring at 55 is not necessarily the right one based on your age, because the target date fund providers are all assuming age 65 retirement. So definitely some things to keep in mind. For those of you that like to manage your own investments, like Keith mentioned, these don't take into account risk tolerance. So the different mix of stocks and bonds and cash in your portfolio definitely varies for every individual to make sure you have the right allocation for your risk tolerance.
Yeah, most plans are going to have tools to figure out that risk tolerance, and if they don't, we can help you out with that too, and do a risk tolerance questionnaire for you to figure out. And that's again how we back into the right mix of stocks, bonds, and cash. Is again starting with risk tolerance and then asking about time horizon and so on.
So next question, if the goal is to retire early, does it make sense to save more into a taxable account over a 401k or IRA?
I think with the uncertainty of taxes, with everything going on in this country right now, and things could change dramatically in 2025, having more tax-free income throughout retirement might be more beneficial. Again, looking to the Roth accounts, the Roth 401ks, 457s, 403bs, to create that income stream where you don't have to worry about the uncertainty there. So it's, with the government, it's actually like pay me now or pay me later. We know what's happening right now. We don't know what's going to happen later.
So tag onto that, right? The taxable account is after tax, but you're going to pay taxes on all earnings, be it fixed income or stocks, dividends, whatever it is, every single year. right? So I think the benefit of the 401k and IRA, where you definitely probably want to max out all contributions to those, is your first place. No matter what, max out those. You can save up to $19,500 in your 401k. I think it's about $6,000 in your IRA, maybe $5,500. Those go up if you're over age 50 with catch-up contributions as well. But I think we typically advise to max out as much money as you can in one of these tax advantaged vehicles. The idea that you can choose pre-tax or you can choose Roth. I think Keith's point is, $19,500 in a Roth bucket after tax is definitely more than $19,500 pre-tax. And if you know the tax rate you're paying today, I know plenty of people in the top tax bracket that think taxes are going to go up no matter what in the future, and they'd rather pay that top tax rate today just to make sure they have tax-free, growth, assets forever. The other thing is, taxable account where it's after-tax money, but you do pay tax on all the earnings every year. In a Roth account, it's also after-tax money, and you pay no taxes on any earnings. And so why would you fund a taxable account before maxing out your Roth account if they're both going to be after tax, but you have to pay taxes in one account and not taxes on the other account?
Yeah, obviously you can see from all of our answers is we prefer tax-free or tax-deferred growth over time, but just know, and you want to take advantage of that match if you get one at your employer. But that money is supposed to be long-term for retirement and not touch until age 59 and a half to avoid that 10% penalty. So if you know you're going to be wanting those funds out, especially prior to that age, then a taxable account might make sense. But yeah, we definitely prefer that tax-free and tax-deferred growth.
Yeah, and going back to the crux of the question, the goal is to retire early, right? Saving $19,500 a year for your lifestyle might not be enough to retire early. So at the end of the day, saving extra in addition to those limits in a taxable account, always advisable. If you can afford to save more money than the retirement limits allow, you should always save as much money as you can. Nobody ever got to retirement and complained about having too much money. Like, that's just not a thing. So the more money you can save and you can afford to save, if you have to go to a taxable account because you've maxed out these tax deferred programs, definitely save as much as you can.
Yeah, when I said that 10% rule of thumb for saving to a retirement plan, if you want to save 20%, you max out on the contributions to the 401k or your IRA, then yeah, start saving into a taxable brokerage account.
Next question is, what are your thoughts on using free day trading apps, such as Robinhood, to invest?
Robinhood is fine. Free is great. From transaction fees that they waive and no cost to have the account. No, there's never any free lunch. So they are selling your data to other firms. So just know that. But the part I don't like is the day trading on that. Everything we were talking about it's boring, but focusing on the long term and not focusing on day to day, week to week, year to year. But Robinhood is fine. There's other custodians out there as well that offer free trading. But if you're trading too quickly and too often, that's what we usually don't favor. It's invest for the long term is where wealth by the greatest investors have been made over time.
Yeah, I think something to add to that. If you think, like I love Robinhood. I have a Robinhood account. It's my fund money account. It's not my long-term savings account, my long-term retirement account. That's where I'm just going to randomly gamble on stocks that I think are going to, like, when I bought Movie Pass on a whim because I could buy it for like 25 cents, and then they basically went bankrupt, right? So that's where it's a gambling account for me at the end of the day. So it's fun. It's like playing fantasy football.
Yeah, we're not recommending gambling. It's more that's discretionary. So after you've saved your 10% and everything else, if you want to do that, but we think the negative with some of the day trading apps is they're creating a lot of day trading and people gambling on the market, which is long term not something we would recommend.
Right. If you make money and you sell a stock, every day, or maybe it's not really day trading, but you hold it for a week or 2 weeks, at the end of the day, you're going to pay taxes on any gains. You can wipe out some of your taxes if you've made any losses, but if that's a taxable account, you're going to pay taxes on all the money you earned in there. So there's tax consequences to trading that frequently. So a lot of considerations to think about, using these types of apps. I think the one thing that I love about them, especially with the popularity and how many more people are using them, is definitely investing awareness. I think that if you're using this to just randomly start investing and start picking a few stocks, don't use it to day trade, would be my suggestion, but evaluate the companies that you're going to purchase and start using it just to watch the markets. It's definitely a great tool to get people engaged with the markets, paying attention to what's going on with stocks, learning how stocks work. What does that percent ownership get you? What does it mean for you? Definitely a great tool to pick up interest and start learning about the stock market and paying attention.
Yeah, and Robinhood obviously was a first mover in this space for the free trading and fractional trading, but there's plenty of other ones out there as well. Schwab, Fidelity, they're all doing it now.
So next question is holding an HSA account for retirement, i.e. saving all medical expenses to reimburse in retirement, a good strategy?
Definitely part of a strategy. Healthcare expenses are increasing 3 times the rate of inflation right now. So a married couple's looking at spending $300,000, give or take, throughout retirement if they retire at age 65. So it definitely plays into it. And I think, Mike, you probably agree you're going to end up going through it as well, right?
Yeah, I mean, I think an HSA is great because, as you mentioned, medical inflation has been a lot higher, and we're an aging society, and that those costs continue to increase. The thing is with an HSA is you should be saving every year and not necessarily using those HSA funds. You should be letting it grow and compound over time. And then having it invested, so many HSA accounts, just you make the contribution that sits in cash or some type of cash instrument. It's not invested. So just make sure the investment account that it's in, it's actually invested in a mix of stocks and bonds.
So next question is, do you have any tips for someone just starting out to investing, just building their savings and starting investing? What tips might you have for those people out there?
I think if we go back to right here, pay yourself first. Start investing in that employer-sponsored plan. You won't even know it's coming out of your check. You get used to it. You get the raise. Anytime you have an increase in income, you were living without that before. That should go towards retirement. So again, set those small goals as well, I think, too.
Yeah, I mean, I think I can add, assuming that you are saving an employer-sponsored plan, maybe saving in a taxable account afterwards. I think one of the things I always recommended all my friends that, every time I'm sitting down talking about, stocks and the markets and things like that, half of them glaze over and they're ready for happy hour to be over. And I think, one of the things for all of them that eventually come to me and say, I'd like to start investing, I'm going to put $5,000 or $10,000 into an account. What I tell them is, to find a few stocks that they love, or find an ETF for a diversified, investment or mutual fund, and start paying attention to it first. And following the markets, listening to what's going on in the news, and Bloomberg and CNBC, listening to these things and paying attention to what's going on in the markets and really understanding stocks, so that you're not just randomly picking a couple stocks. Like I want Carnival Cruise Lines today, and I want Tesla tomorrow. I want the airline stocks this day. But start paying attention to them and understanding what makes them go up, what makes them go down, such that you're not only just putting money in there, but you're now understanding what's happening with your money as well. Definitely a way to start to learn about investing for somebody just starting out. Next question we have is, if you have approximately $15,000 in credit card debt, would you recommend taking out a personal loan at 8% to pay them off versus the normal credit card rates?
It's just arbitrage. I mean, typically, if you can get a personal loan at 8% and your credit card debt is at 20%, it typically would make sense from a being able to arbitrage that. You're not paying 20%, you're only paying 8%. So that'd be good. But I mean, obviously, you want 8% is even high. You'd like to work that down next. So just have a plan for working down that personal loan next, and not building that credit card debt back up. And then all of a sudden you've got a personal loan at 8% and you've built that credit card debt back up to the 15 or 20,000 again.
Yeah, I think it's definitely make sure. So you had a couple of things. Definitely watch probably part 1 of the series 2, where they talk a little bit about credit cards and strategies for that, and credit and understand if you take that loan, there's going to be a hard inquiry on your credit. So how does that impact your credit score? Are you looking to refinance or buy a new car anytime? And how might that impact your car payment or your mortgage payment? You're having that inquiry on your credit. And also just making sure that you can get that personal loan for 8%. I know there's a lot being marketed out there, but oftentimes those 7 to 8% personal loans are for the best credit out there, somebody above 800. And if your credit isn't above 800, maybe it's only 700, then really you might not actually get that 8% being marketed. They might give you something closer to 14 or 15%, around the same as your credit card.
Sorry, Chad. Yeah, know the terms like Chad's mentioning. I mean, is that 8% reset after 2 years up to 15% or whatever, and what's your time period to pay that off?
Yeah, and are you paying it back over 3 years or 5 years or 10 years? And so how much interest are you going to pay by taking on that personal loan? And then most importantly, if you do that, say you can get 8% and it's going to pay off all 15 grand, then as soon as you pay off those credit cards, you should put those credit cards in your drawer. Or I think Paul talked about his webcast last week, the freezer approach, where you just put them in a glass of water and actually put it in the freezer. Because at the end of the day, to take out a $15,000 loan at 8%, you have zero credit card debt. But by the time you've paid off that 8% loan, you're back up to $15,000 in credit card debt. You're just getting yourself in a revolving door situation. So
yeah,
I
love that example Paul gave. Put your cards on ice.
Yep. Next question is, do you recommend micro investing using robo investing apps like Acorns?
Yeah, I think it's a great place to start. I think there was the other question about getting started, and so again, first focus on getting that match if your employer provides one. That's free money and contribute to your retirement plan. But if you've got additional funds after maxing out that you want to invest in a taxable account, some of those robo accounts are a good place to start. They're usually low cost, and costs usually eat into obviously return. So, but there's so many different ones out there, and how are they investing? There's I'm not going to comment specifically on Acorns. I don't know.
Yeah, I think that it goes back to the idea is any way that you can start investing and saving, if it's going to help you, that's a great idea. I think, my wife loves the Bank of America. Every single time she has a transaction, all the extra change gets rolled over to her savings account every single time. And so it just boosting her savings, 10 cents or 25 cents at a time. But, those little amounts, when you think about how many transactions come out of your bank cards, do start to add up. So any way that you can start investing, if you don't have any savings account, that's definitely a good avenue to go. Again, we don't know Acorn's site. I don't want to give them an endorsement or anything like that.
We looked at a study, I think, what was it, June 30th, Chad, when the various robo websites and the performance differential and the mix of bonds that they had, it was all over the board for the first 6 months. So that's why we really went on one specific one, because they can all be different in what they're providing. What the free tools are, again, there's no free lunch. They're getting something. If it's your data or some other thing, or if it's Bank of America, they might be selling you a loan or something else on top of a credit card. So just aware of all of that too. But it's a great place to start saving and investing. Never done it before.
Yep. That's great. Thank you all. And so that was our last question for today. So again, please fill out, there's a QR code on the screen. There's also, I just posted in the chat box, a link to our survey. Please fill out if you have just 1 to 2 minutes. Let us know what you thought of the content today, as well as any future topics you might be interested in hearing about as we continue to plan these series. I think we already have one planned out for January of 2021 as well. So definitely let us know your feedback and thoughts. And thank you all for attending. Have a great evening.
Thank you, everyone.